Hello, welcome back to the video. My name is Andrew Kuhn, Focus Compounder. Thank you so much for tuning in with me here today. In today's video, we are going to be going over 10 golden rules from Peter Lynch's Beating the Street. So this is the first time that you're tuning in with me here today. I want to thank you so much for joining in. Be sure to hit that subscribe button, thumbs this video up, and check out all the other content that my partner Geoff Gannon and myself have. We blog about ideas at focuscompounding.com. We both manage capital for investors at Focus Compounding Capital Management. And then we also have a very popular podcast with a ton of investing content, over 126 different episodes at Focus Compounding on the Podbean or your iOS app. So thank you so much for tuning in. And like I said, be sure to hit that subscribe button. We're pumping out 5 videos a week and we're having a lot of fun doing it. So in today's video, like I said, we are going to be going over Beating the Street by Peter Lynch. Peter Lynch is an absolute legend and an investor that you should definitely study if you haven't yet before. He ran the Magellan Fund through Fidelity and is definitely one of the better investors of, like I guess our generation or investors that we should study. And in the back of the book, in this in Beating the Street, he has 20 golden rules for investing. And what I did was I went through and I highlighted my favorite 10, and I will share those with you here today. So the first one is your investor's edge is not something you get from Wall Street experts. It's something you already have. You can outperform the experts if you use your edge by investing in companies or industries you already understand. And I think that's a great first principle that everybody should really focus on. Stick to what you know. I've always talked about the too hard pile. There is over 50,000 different securities worldwide. You do not need to know everything about every single company. Can't even express that enough. Geoff and I, we were studying a business the other day, and I don't want to go into the actual technology behind it, but I read the write-up and I had pretty much no idea what I just read because I didn't understand the technology behind it. Geoff and I sat for 2 hours and he, very nicely, as he always does, walked me through the technology and what this means and stuff like that. But if it were just myself, I just would have put it in the too hard pile and probably have just moved on to the next business. Again, you don't need to know everything about every single company. Now, the other side of that is if other people don't understand it, or if you don't understand it, that could mean that other people don't understand it, which means that there could be a potential mispricing there. But again, at the end of the day, stick to what you understand. If something's too complicated for you and you're not interested or excited about learning about it, put it in the too hard pile and move on to the next business. So, number 2. Over the past 3 decades, the stock market has come to be dominated by a herd of professional investors. Contrary to popular belief, this makes it easier for the amateur investor, you. You can beat the market by ignoring the herd. And I think that's everything that Geoff and I try to do at Overlooked Stocks and why we focus on investing in overlooked stocks. In the past video, I demoed out the difference between a non-overlooked stock and an overlooked stock. We went over Amazon and compared it to the Daily Journal. The Daily Journal has a beta of less than 1. The shares only turn over, I think, about 65% per year. Compare that to Amazon, which is one of the most widely followed companies in the world. The shares turn over 1.6 times a year, and the beta is more than 1. So that is one of the most followed companies. You're not going to find a lot of pricing inefficiencies. All of the professional investors are focusing on those companies. So stick to overlooked companies, and you'll find a lot more inefficiencies. And again, I'm not saying that Amazon can't become undervalued, because of course that's true. But as you, the investor, the individual investor, you should focus in a different pond than funds or other investors that are investing hundreds or billions of dollars. So, number 3, often there is no correlation between the success of a company's operations and the success of its stock over a few months or even a few years. In the long term, there is 100% correlation between the success of the company and the success of its stock. This disparity is the key to making money. It pays to be patient and to own successful companies. And this reminds me a lot of Warren Buffett's quote of, in the short term, the market is a voting machine, voting upon traders trading, geopolitical events, short-term earnings, pretty much everything that doesn't have to do with the long-term fundamental value of a business. But in the long term, it's a weighing machine, weighing to the true fundamental facts. There in between is opportunity for you. So focus on good businesses that are incredibly durable, incredibly predictable, produce a ton of free cash flow, have reinvestment opportunities potentially to redisperse that cash flow, concentrate on those companies, and just stick to companies that earn high returns on capital. And over time, just like Mr. Lynch just said, the stock price should approximate the actual business returns. So check out the return on equity video that Geoff and I just did last week when we went over that. Okay, next one, never invest in a company without understanding its finances. The biggest losses in stocks come from companies with poor balance sheets. Geoff and I tend to stick away from leverage. I would suggest to a lot of people, maybe if you're more on the amateur side, stay away from companies with debt. It's very hard to go out of business if you don't have debt. It's just not going to happen. Next one, avoid hot stocks and hot industries. Great companies in cold, non-growth industries are consistent big winners. This is something that I think I've evolved on as an investor over the past couple of years. The biggest surprise to a lot of people, because we put up, a lot of stocks that we've been investing in through focused compounded capital management. Maybe they have an annualized return of, better than the market or exceptionally better than the market, but they're not all growing their top line by, an exponential amount like you would think. Good growth could be even 6 to 8% if the company generates a ton of free cash flow, is trading at some sort of free cash flow yield, and has maybe reinvestment opportunities for that cash flow. Geoff said you can outperform the market especially if you think markets are going to do maybe 8%, averaged out over time. If you buy a company that's trading at 10% free cash flow yield, doesn't have a ton of growth, but it's buying back its stock, you can outperform the market. So I would try to stay away from companies that are posting incredibly high top line revenue growth, unless of course you get to buy or pay a cheap price for that top line growth. But a lot of the companies that we invest in, they're not all big growers, but they all perform incredibly well. And you're not investing to the market's future expectations as opposed to it just continuing to do business as usual, produce the cash flow, and go on about their business. So next one, if you invest $1,000 in a stock, all you can lose is $1,000. But you stand to gain $10,000 or even $50,000 over time if you're patient. You need to find only a few good stocks to make a lifetime of investing worthwhile. And obviously that's the heart of everything that we do, focused compounding. We are trying to compound capital. Compound interest is the eighth wonder of the world. Obviously that's what Einstein said. Warren Buffett's preached it. Everyone that is watching, I'm sure, is familiar with the concept of compounding. So at the heart, that's exactly what we're trying to do. So next one. Everyone has the brain power to make money in stocks. Not everyone has the stomach. If you are susceptible to selling everything in a panic, you ought to avoid stocks and stock mutual funds altogether. Obviously, like I said, getting back to that weighing machine versus voting machine, sometimes prices can become pretty crazy. So you want to be able to have the stomach to stick to the fundamentals and be able to, withstand any sort of crazy volatile moves in the market. Again, the way you can do that is by focusing on the business first. Try not to pay attention as much to the stock price. The stock price is just a liquid way, I guess, to buy a minority interest in a real business. Think of stocks not as pieces of paper, but think of them as what they are, which is fractional ownerships with real businesses, real assets, and real managers. You're buying a piece of a real business that you hope will pay dividends to you in the future. Next one, nobody can predict interest rates, the future direction of the economy, or the stock market. Dismiss all forecasts and concentrate on what's actually happening to the companies in which you've invested. So again, Warren Buffett and Charlie Munger have said they've never not made an investment because of some sort of macro, data or macro situation. Geoff and I, we are the same way. We never really pay attention to interest rates. We know exactly what they're doing, but we don't forecast any of that into our analysis. We're looking to buy good companies, trading at cheap prices, businesses that have long-term contracts or high customer retention rates. So we try to really find these cockroach-like businesses that are incredibly sticky, that aren't going to be susceptible to moves and gyrations in the market. So those are the types of companies that you should focus on. Last two, if you don't study any companies, you have the same chance of success buying stocks as you do in a poker game if you bet without looking at your cards. And this actually reminds me of Joel Greenblatt's quote where he said, invest in a company without doing your own due diligence is like running through a factory, I think, with a firework or something along those lines. And he said, you may make it through, but you're still an idiot. So don't do that. Do your due diligence, learn about the businesses, learn the key drivers in the company, try to get comfortable with the management and the way that they think, read their investor letters, and just do your homework. And then the last one is time is on your side when you own shares of superior companies. You can afford to be patient even if you missed Walmart in the first 5 years. It was a great stock to own in the next 5 years. Time is against you when you own options. So that reminds me of the quote that time is the friend of a business that could compound and is not the friend of a business that just destroys value. Options obviously could speed up or could detract. It really what it is a form of leverage. You can't time the markets, so obviously options are just not a good way to play certain investments. So I want to thank you so much for tuning in with me here today. Be sure to check out all my other content. Follow me at Focus Compound. Hit that subscribe button. Thumbs this video up. Check out the podcast, and we'll see you in the next video.